there's a mix-up I've noticed on when you start the count, the push count. Now, the first thing I want to explain to you is that a push is not necessarily a bar. It is actually a sudden jump in your P&L. That's what a push is. So if the push is, if the movement in your P&L is not sudden and it's gradual, like penny by penny by penny, that's really not a push. That's more of a slide, right? So you can have something like this that doesn't really have push qualities. Like that would be a push, right? So it's a sudden, abrupt jump in your P&L. Okay. Um, you can have a bar. So a bar doesn't necessarily make a push. If the bar is not a sudden jump in your P&L, then it's not a push, right? And so um, you can have a bar that is two pushes. Like inside the bar, your P&L jumps like more than once. Okay. And I've always said this, what if I were to give a push a sound, it would sound like, not like a constant drip of water, but it would sound like a sudden flurry. Like that. You see your profits run. Okay. Um, now you don't count pushes. You don't count your event as the first push. You don't in your count. So let's say, for instance, you're playing something like this. Here is a 200 right here. And you're buying, let's say you even buy into this, boom, into that nice fat elephant bar. That's not push one. Okay. The push is after the event. You start counting after the event. So that would be your first push. Okay. Now, let's say from here, your stock does this, pauses, right? And then it does this. Now, that's not a push either, because each push has to be higher than the last one. So then this would be push two. This would not be considered a push. Okay. And of course, this would be three pushes. Now, you're not obligated to take profits on or beyond the third push. It is just a right. You have the right to take profits in the zone of the third push. So what a lot of traders do is after they get their second push completed, they will place advance orders to sell in the third push territory before the third push materializes. So the orders are often waiting in third push territory. All right. Guys, are you seeing the white screen that I'm drawing on? Is it visible to you? Okay, cool. Okay. Now, um, if you sell two, if you buy two lots there, on your third push, what do you have the right to do to sell how much of it? Right. Only one, right? You do not have a right here to sell all of it. The idea is that this is the first part of the move. Now, the if you have three, I didn't used to do this, but I give you now the right to sell another, but you'd want to try to do that on another push, which would be push 4 if you could get it. All right. If you had 4 lots, you could just keep selling every single additional push all the way down to your 1 lot at least. Okay. So the idea is that you can take profits depending upon your size. Starting from the third push, you can take profits on every push after the third one as well. Okay. Now I want to tell you how this came into existence. I know it's going to be a bad drawing here, guys, but here is, if I'm doing this right. That's an elephant. I know it's a bad one. Now, elephants have 4 feet. Now, the idea is that elephants or big money institutions, we call them elephants, all right? They jump into a market 1 foot at a time. You understand? They're not like retail traders that buy everything at once. That's not how you do it. You can't buy 88 million shares of a stock all at once. You have to buy that over time. And so elephants or institutions get into the market. The assumption is that they get into the market 1 foot at a time. Once they are in the market, or I always use the metaphor, a tub. So once this elephant puts 1 foot in the tub, he's got 3 more feet left. And he puts the second foot in, then the third foot in, then the fourth foot in. Now the elephant is completely in the tub. And the last thing he does is sits down. So this is the typical 1, 2, 3, 4, 5 wave move that stocks that are running often have. And so in essence, the first elephant foot in this one, the first one, is your event. This is this one. The second one is your buy a lot of times. Okay. Sometimes the first one is your buy if it's an anticipation. But oftentimes you're buying into the bottom portion of the second one. Okay. Most runs are going to peter out here. Ah, most runs are going to peter out there. So this is why you are taught to start the sell process here. See? Now you still have the possibility of a fourth and a fifth one happening. This is partly why you don't sell all on 3. because you would then be cutting out the fourth leg and the last leg and the sit down possibility. Okay. So we don't want to also assume that it's going to be a 5 wave move because they don't always materialize. So I start you in the middle because the vast majority of the strong moves will give you 3, okay? But you might not get, the odds start to drop off whether you're going to get a 4th or a 5th. And so we start at 3. Now, we don't want to get rid of everything at 3 because now you have eliminated the possibility of grabbing the 4 wave plays and the 5 wave plays. All right, so it's all based on the number 5. That's where the push rule comes into play. Now, some traders were asking, what if I get into this play late? Like, what if I get into the play here? You have to understand where in this process you are starting. Because if you get in here, your push, you can't look for, you might get a 3 push, but you're getting in the whole game late. So it's not the push count from where you buy, like you don't start the process. It's where the elephant is in the tub. If you jump on board the elephant's back and he's already got 3 feet in the tub, you can't expect 3 feet more. He doesn't have any three more feet. You follow what I'm saying, guys? And I get traders who say, well, Oliver, I would say, but why did you, first of all, why did you get in here? And why did you not get out here? I was waiting for 3 pushes. I'm like, yeah, but you can't wait for 3 pushes after 5 pushes already.